If you were born before 1966, there is a clock ticking on your wall that you cannot see, and by the time you hear it, it will be too late. While the news is talking about politics, the rules at Medicaid quietly changed in ways that let the government take your house, your savings, and your dignity before they ever pay for a single day of your nursing home care. There are 3 accounts that the government pretends do not exist. Banks do not push them. Insurance agents will not mention them because they do not get a commission. But they are real, they are legal, and they can shield tens of thousands of dollars from Medicaid's grab. By the end of this video, you will have the exact form number and the exact phone number you need to stop the government from counting money the law says they cannot count. Stay with me, because if you miss the next paragraph, you could lose your home. The Medicaid system was built to help the poor, but the way it works in 2026 is brutal. Before Medicaid will pay for a nursing home, a home health aid, or assisted living, the government looks at every dollar you have. They call this the asset test. In most states, you are allowed to keep only $2,000 in your name. $2,000. If you have more, you are out of luck. They will not pay. They will let the bills pile up. They will let them come after your children's inheritance. And many families, instead of using the legal tools that exist, simply give money away. They sell the farm, they drain the savings account, they hand checks to grandkids, and then they hit the 5-year look-back. That is a hidden trap. If you gave away money in the last 5 years, Medicaid can disqualify you for months, even years. So the people who tried to be smart end up punished twice. There is a better way. There are 3 invisible accounts. Let me walk you through each one in plain English with real dollar numbers so you can see exactly what they mean for you. This is why you need to hit the subscribe button right now. The rules are moving faster than the mail, and if you are not subscribed with notifications on, you will find out about these changes after the money is already gone. The first invisible account is called the Irrevocable Burial Fund. This is not just a savings account you tell your family about. This is a specially designated account that the Medicaid rules say does not count toward your $2,000 limit. If you set it up the right way, with the right words on file, with the money locked away for one purpose only, the government has to pretend it is invisible. They cannot see it. They cannot count it. Most states let you put $10,000 in there. Some states let you put $15,000. Some states let a married couple split it, so a husband and wife can shelter $30,000 combined. That is $30,000 of life savings that stays in your family and out of the government's hands. Here is the 2026 rule you must know. The account must be irrevocable. That means you cannot just change your mind next year and pull the money out for a kitchen remodel. The word irrevocable means you have signed a contract that says this money belongs to the funeral, to the burial, to the cremation, to the headstone. It must be separate from every other account. It must be titled clearly. And this is where most seniors get killed. They go to the bank and the teller opens a regular savings account and labels it burial. That is not enough. The government looks at that and counts it. You need the specific fund designation on file. You need Form SSA 7104 or your state's equivalent on record. You need an itemized estimate from a funeral home showing exactly what the money will be spent on. Without that paperwork, the account is visible. With that paperwork, the account is invisible. Let me show you what that means in real dollars. Say you are single and you are facing a $4,000 a month nursing home bill. Medicaid will pay that bill, but only after you are down to $2,000 in countable assets. If you did not know about the burial fund, you would have to spend down every dime. You would cash out your CDs, sell your bonds, and land at $2,000, broke and exposed. If you did know, you could have parked $10,000 in the burial fund and kept an extra cushion of $3,000 in a separate compliant account. That is $13,000 of life savings that stays legal, stays hidden, and stays in your family for the funeral you were going to pay for anyway. Over 10 years at 4% interest, that is roughly $4,000 more dollars earned, completely shielded. That is the difference between a funeral your children pay for out of pocket and a funeral already paid for, in full, with dignity, the day you need it. The fix is simple. Call your local funeral home this week, ask them to draft an irrevocable prepaid burial contract, make sure they itemize every cost, then open a separate bank account titled Irrevocable Burial Fund for your name with the funeral home listed as the beneficiary. Do not commingle it with anything else. Then call your state's Medicaid office or your area agency on aging and ask which form number your state uses to certify the burial exclusion. Get that form filed. That is your shield. I need you to share this video with one person in your family born in the same decade as you. If we do not look out for each other, no one will. The second invisible account is called an ABLE account. This one is the best kept secret in Washington. ABLE stands for Achieving a Better Life Experience. The law was passed so that people with disabilities or people who became disabled before a certain age could save money without losing their Medicaid. The 2026 rule just expanded. Under the Secure 2.0 Act, the age when disability must have begun was raised from 26 to 46. That means millions more seniors now qualify. If you became disabled between the ages of 26 and 46, and you never opened an ABLE account because you thought you were too old, you were wrong. You can open one in 2026, the money goes in tax-free, it grows tax-free, it comes out tax-free if it is spent on qualified disability expenses. And here is the magical part for our conversation. The federal rules say that for Medicaid eligibility, the funds in an ABLE account up to a certain limit are not counted as an asset. The government does not see them. They are invisible. Let me show you the real dollar difference. The 2026 contribution limit for an ABLE account is $19,320 a year, the same as the standard gift tax exclusion. Suppose you are 64 years old, you have been on Social Security disability for 4 years, and you have a sister who wants to help. She can put in $19,000 this year and $19,000 the next year. That is $38,000 in 2 years, completely outside the Medicaid asset test. If your sister does this every year for 5 years and you earn modest returns, you can roll past $100,000 in protected money. Compare that to a regular savings account where every dollar above $2,000 disqualifies you. The ABLE account is $1 million shield disguised as a checking account. But here is the real dollar mistake families make. They open an ABLE account, but they spend the money on non-qualified things. Cable bills, vacations, new tires. The IRS calls those distributions and they are taxable. More importantly, after you die, any money left in the ABLE account may be subject to a Medicaid payback claim if you used Medicaid during your lifetime. So the money is private, but it is not permanent. The fix is to use the ABLE account for what it was built for: housing, medical bills, assistive technology, transportation, job training, prescription drugs, therapy, keep receipts for everything, document the disability connection. Then, when you pass, the remaining balance goes to your heirs, and the Medicaid payback is calculated only on what Medicaid actually paid out, not on the full balance. That is a negotiated outcome, not a wipeout. Check that bell icon. If it is not turned to all, YouTube will not tell you when I post emergency updates on these benefit bans. The third invisible account is called a pooled income trust, sometimes called a Miller trust. This one is for seniors whose income is too high, not their assets. If you have less than $2,000 in the bank, but your Social Security check plus your small pension adds up to more than your state's Medicaid income limit, Medicaid still says no. In 2026, in most states, that income limit for a single applicant is roughly $1,300 a month. If you get $1,500, you are locked out. You cannot pay privately for a $4,000 nursing home. You will burn through your savings until you are broke, and then you still have to wait. The Miller Trust solves this. You take that excess income every month and pour it into a pooled trust run by a nonprofit. The trust holds it, uses it for your care, and at the end of the month, you still pass Medicaid's income test. The income becomes invisible. The trust is invisible. The dollars stay inside a legal container that Medicaid recognizes. Here is the real dollar love letter to this little-known tool. Say you are 73, widowed, and you get $2,200 a month between Social Security and a small pension. Your state's Medicaid income limit is $1,300. You are $900 over the line every single month. Without a Miller Trust, you cannot get Medicaid to help. With a Miller Trust, you put that $900 into the trust, and Medicaid sees that your income is $1,300. You qualify. You preserve your $2,000 asset cushion. You keep your burial fund. You keep your home if a spouse or dependent child is still living there. And the trust continues to pay your extras, your phone bill, your dentist, your shampoo. That is roughly $10,800 a year, redirected through an invisible legal pipeline that would otherwise have disqualified you and forced you to spend down to ruin. The fix is to call a nonprofit pooled trust operator in your state. Every state has at least one, usually several. Ask for the enrollment kit, ask about the setup fee, ask about the monthly administrative cost, then call an elder law attorney to make sure your will, your power of attorney, and your beneficiary forms all line up with the trust. Get this done before you ever apply. If you apply first and then try to fix it, the 5-year look-back can wipe you out for years. Now let me talk to specific groups, because the real dollar cost of getting this wrong hits different people in different ways. If you were born between 1943 and 1954, you are in your 70s or early 80s, and you are the most likely group to face the nursing home decision in the next 10 years. Your danger is the asset spend down. You have the most to lose and the most time left to lose it slowly. Your fix is the burial fund, set up this year before anything else. Do not wait. Do not let your adult children talk you out of it. If you were born between 1955 and 1959, you are turning 65 to 70. You are just entering the Medicaid risk window. Your danger is the look back. If you retire, start gifting money, and then 3 years later you have a stroke, those gifts will be counted against you. Your fix is also the burial fund, plus a properly structured promissory note or caregiver agreement drafted by an elder law attorney so that any money you transfer to family is repayment for a real documented service, not a gift. If you were born between 1960 and 1966, you are the group that almost never thinks about this. You feel fine. You feel bulletproof. But disability does not care about your birthday. If you became disabled between the ages of 26 and 46, the new 2026 ABLE account rule just unlocked a $100,000 shelter for you, and most people your age have no idea. Your fix is to look up ABLE account enrollment online right now before the political winds shift. Hit the like button on this video because the algorithm rewards engagement, and engagement keeps this information in front of the seniors who need it most. Now, the income tax trap you have never heard of, the IRMAA surcharge. Even if you keep every dollar protected from Medicaid, the IRS has a parallel trap on Medicare premiums. In 2026, if you are single and your modified adjusted gross income is between $109,000 and $137,000, your Medicare Part B premium jumps from the standard $202.90 a month to $284.10. That is $1,000 extra a year taken out of your Social Security check before it ever hits your bank account. If your income is between $137,000 and $171,000, the premium climbs higher. Above $500,000, your Part B premium becomes $689.90 a month. That is almost $6,500 a year, just for one part of Medicare. The fix is to watch your 2-year-ago income. IRMA is based on your tax return from 2 years back. If you are about to retire, take a capital gain, sell a rental property, or convert a traditional IRA to a Roth, you can manage which tax year that income lands in. Talk to a CPA about an IRMAA appeal form if your income has genuinely dropped due to retirement. Now, the marriage question. Widows, widowers, and divorcees have hidden protections and hidden dangers that married couples do not. If you are widowed, you may be eligible for the survivor benefit on your late spouse's record, and the bigger of the two checks may be yours for the rest of your life. If you were born before 1960 and you have not filed for survivor benefits yet, go to ssa.gov and run the calculator before you do anything else. If you are divorced after a marriage that lasted at least 10 years, you can claim on your ex's record if you have not remarried. Most people never apply. They leave $20,000 a year on the table for the rest of their lives. Now, the health status question, Part B versus Advantage. If you are healthy and you do not see many specialists, a Medicare Advantage plan can look cheap. But if you develop a chronic illness, the co-pays stack up, the networks narrow, and the prior authorizations pile up. Traditional Medicare plus a Medigap supplement gives you freedom of choice nationwide, and it is the only path that protects you if you travel, if you move to be near a child, or if you need a specialist at a teaching hospital. The trade-off is higher monthly premiums. The fix is to enroll in Medigap during your 6-month open enrollment window, which begins the month your Part B starts. Miss that window, and in most states, the insurer can deny you for pre-existing conditions. This is the most common, most expensive mistake seniors make, and it is invisible until the day they need it. This is why I keep saying, hit that subscribe button. The buried truth is that the rules keep shifting. The 2026 COLA was 2.8%. The Part B premium jumped $17.90 a month. The SSA's overpayment clawback is back in force after March 27, 2025, and they can now take 100% of your check to recover money they say they overpaid, sometimes going back decades. If that lands in your mailbox, you have 90 days to appeal and 30 days to request a waiver. Do not ignore that letter. Do not throw it away. It looks like junk mail. It is not. Open a binder this week. Print this video's summary. Write in it the 3 accounts: Irrevocable Burial Fund, ABLE account, Pooled Income Trust. Write in it the 2 phone numbers you actually need. The Social Security National Line is 1-800-772-1213. Your local state health insurance assistance program, or SHIP, offers free, unbiased Medicare counseling. Find yours at shiphelp.org. Call both before you sign anything, before you sell anything, before you gift anything. The minute you act with information, the invisible accounts open. The minute you act without information, the government sees every dollar you have. Share this video with the one person in your family most likely to need it. If that bell icon is not lit, light it now. And remember, those 3 accounts are invisible because the system does not want you to see them. Now you do.